Great, great. So thank you everyone for joining us today. Um, Today's session is basically on um, is startup compliance an unnecessary expense? So today we have Suswagata Roy, who is the partner at NKR Law Firms, right? And we have Mr. Sushanto Mitra, who is the founder and CEO of Lead Angels. Um, he will be taking you through what Lead Angels has been doing, how due diligence really matters, and what are the prerequisites that are required for startups and for investors before investing in them. So over to you, Sushanto, and all the best. Thank you so much.
Yeah, thanks. So I think uh, when we were in, I'll just go back. So prior to setting up Lead Angels, I was running the incubator at IIT Bombay. It's called Sign, and I think Devinder is here. So Devinder runs an incubator in Gurgaon. So since it was IIT and the people who were coming in were students of IIT, nobody really bothered to have a shareholder agreement. Nobody, went into the articles of association. And you'll be all be surprised. The moment we started investing in these companies, uh, am I audible? You can hear me?
Yes, Sushanta.
Yeah.
Yes, Sushanto, we can hear.
So the moment we invested, all these, alma mater of IIT Bombay started issuing themselves uh, rights, preferential issues, and the stake of Sign from 4% straight away went to 2%. So here is a situation where a transaction was being done between parties who were once upon a time and was a teacher and a student. And then, of course, they went into a commercial relationship. And that was not the intention of Sign to reduce its holding from 4% to 2%. It just goes to show how important, having a shareholder agreement, doing due diligence. After Sign, I went and joined another angel network called Hyderabad Angels. And we were about to invest in a company uh, when we found that the founder had taken a 5 lakh rupee investment from her uncle, who happened to be an NRI, and forgot to take permission from RBI. And we found out that the penalty for this is, uh, you know, about 60 lakhs, which was more than what Hyderabad Angels was investing in the company. There again, I think got quite a few shocks. And then when I set up Lead Angels, from the very word go, we were very careful uh, about all these aspects. Not because that you will most of the time you don't need these things, but there is always a chance of going wrong. And as the Indian ecosystem gets more and more uh, mature, and more regulations come, those of us who are here know that even regulations for private limited companies have increased substantially. We are an AIF, a lot of regulations have gone up for us. So while our primary work is about evaluating companies, we don't uh, uh, neglect the legal and financial aspects. And for that, we have smart and young lawyers who understand the startup sector, like Swagata here, to help us, traverse through this maze of laws and regulations, which, as you know, in India keep on changing. So I just want to put that context over to you, Suswagata, to talk a little bit about yourself and your journey with startups.
No, thanks, of course, Sushanto Lead Angels team for having me. To talk about my, or rather our firm's journey, which is NKR with startups, right? We're of course a firm based out of Delhi. It's three of us. We do both disputes and we do as well. And I personally handle the investment side, right? So we do both fund size investors.
I can't hear him. Can you?
I guess we lost Suswagata. Hi, Suswagata, we lost you
I
for good
think,
20 seconds, I guess.
oh, okay.
Yeah, yeah.
Uh,
You were
so
saying you handle investments and
Yeah,
startup
exactly.
compliance.
And I was just saying that, our association with Sushanta goes back to 2019, when I think Sushanta and I worked on the first deal together then. And since then, we've continued working in this space, both with seed investments, with pre-series A. Now some of these companies are reaching Series A. I'm working with a client right now, right, who set up their business sometime in 2019, raised like 5 lakhs, 10 lakhs, 20 lakhs, suddenly now has some 25 crore offer from Peak 15, right? So he's over the moon, right? So we end up doing a lot of work, both compliance and regulatorily, to help sort of both startups, investors when they evaluate it, to look at, the SHA, the SSA, the investment, the diligence that goes with it. And of course, there is also long-term requirements both on the investors and on the startups end, right? Like with reserve matters, if a startup wants to set up a new subsidiary, if they want to sort of expand outside India, what are the things to be mindful of? What are the things to think about, right? So all of that, like I said, our firm's called NKR. It's not a very imaginative name. I am R in that, right? So, but yeah, we've been doing this for 5 years. My partners, of course, like I said, they are in litigation, so in fact, we work with a lot of startups also on the litigation side, right? So sometimes you'll be surprised to hear actually, you'll be actually surprised to hear actually how some of these issues in fact do go into litigation. Like, you don't think an SHA is going to litigation, but it does, right? I mean, there are transfer provisions which actually end up getting violated, which results in sort of issues in terms of how do you go to court, how do you go to the NCLT, set that aside, right? So we've been doing a bit of litigation, a bit of the advisory, both things.
Can increase the volume. I know bongs are known to be voluble, but for a change, you're not. So if you can be.
Is this better?
Yeah.
Yeah. Okay.
Much
Perfect.
better. Perfect. Thank you.
Sorry, I know, but I'd rather not bore everybody with the introduction the second time around. So maybe I think, we can just start, Sushanta. Sushanta, you're on mute.
So there are a bunch of startups here in this, and there are, of course, angel investors. So for both, before seeking investors, what is your advice to startups? And before investing in a startup, what is your advice to investors?
I think there are many more competent people here to give general advice, but I can certainly comment on some from a legal perspective in terms of things to think about. The one thing that I have been seeing, at least in the last 3 to 4 years, is regulatory outlook has been substantially changing in our country. Where regulators, especially if you're in a fintech business or insurtech or real estate, and even in fact with a lot of companies act requirements, regulators are becoming a lot more proactive about new laws and new requirements. That's something that you were speaking about, right? For example, the RBI, at least on the fintech side, has come out with a whole slew of actions in the last 1 year, right? From new regulation to actually taking actions against people for KYC, right? So, for example, they've been so hard on KYC of late. Similarly, we've been seeing the Registrar of Companies and the MCA taking action against companies for Companies Act non-compliances, right? Some of these have simply gotten picked up where, they've come back with a query and suddenly it's resulted into something a lot more complicated. So I think definitely one is, and today with the Data Protection Act, which is now just sort of months away from full level implementation, that's also going to bring in a lot of requirements, consent requirements on how you deal with personal information. So customers, especially if you're in a sort of SaaS business where there's a lot of personal information being exchanged, requirements around that are also increasing. So I think the first level is definitely to think about regulatorily what space is your business in, what regulatory concerns are likely to happen. And based on that, I think, and that's a question that I also hear a lot of founders today tell me, right? Where often investors, the first level of engagement is to ask, okay, is your business regulated? Have you spoken to a lawyer? Have you gotten a sense of that, right? So I think definitely that, right? I think the first step is to think about regulatory requirements. How compliant are you with that? And how non-compliant are you with some of the more active regulators, so as to say, like the RBI or SEBI, right? I think MCA is still not as active as you would sometimes see the RBI or SEBI being about this.
Absolutely. I think recently we saw some of the investment platforms as well as startups get into trouble by trying to sell their shares, effectively making a public issue of a private company. So even when startups go and to seek investors, they have to follow certain regulations and so on.
No, I mean, for example, the RBI is recently, sorry.
Yeah, go ahead. Please go ahead.
A wallet, right? And it's probably the first action we're seeing in like 10 years, right? Where the RBI is kind of publicly called out and said, you are running a wallet, you have to stop.
Right. So, if you were to say that from a startup perspective, and what are the services that do they require? If a startup has found a bunch of investors and now wants to, consummate the deal through a shareholder agreement and whatever, what are the steps that they need to take?
So
Yes.
Swagat,
Sorry, if you were to start from the point where like you mentioned, right? Like, so there is an investor, there is interest. What do you need to do? And I think that's an evolving exercise for various reasons. For example, I can tell you today, like the MCA system absolutely refuses to run properly, right? For the last 3 to 6 months, we've had investments that have gotten held up for weeks and months because forms are not getting filed on the MCA in time. Things are not happening, right? So actually today's problem is the MCA, if you ask me, right? Is being able to increase authorized capital in a timely manner, is to be able to complete your filings in a timely manner, because they made all filings approved, right? So in fact, as a result of which, if somebody comes to me today, I would tell them today, you need to increase your authorized capital so you can issue these shares to the investor, because we know that filing is going to be a 1-month process. 6 months back, that problem, 2 months back, actually, that problem was GST registration, because GST registration was actually getting held up. I know somebody who was looking to acquire a company to get a GST registration in a timely manner, right? So I think with these challenges, what your requirement is does keep evolving. So I think you have to look at it and say, okay, certainly maybe it's authorized capital at this point. For example, a lot of funds have mandates where they can today only invest in startup registered companies and in MSME registered companies. So for a lot of people, getting that in a timely manner becomes important, right? Because otherwise, the fund has issues with drawdown, the fund has issues with capital utilization. So you have to sort of look at the problem, look at it in context. What is the problem, the big area in that day, and then think about it, right? Like in terms of what are you trying to do, how are you trying to deal with it. For example, a lot of people are friends and family investors, right? And suddenly there's a whole question on how did you take money from them? Did you even like follow any legal compliance to take money from them? Right.
That is what usually happens. A lot of very young startups just take money from without maybe even documentation, and you end up having a lot of shareholders. That is one. Not having documentation is one problem, but having too many shareholders in the long run, what are the challenges that you see I've seen in companies?
No, I think long run, having many shareholders, Sushant, you're on point, right? It does become challenging because that means you need to get a SHA signed by 60 people. Because a precondition to any sort of mid to late stage fund investing will always be that your SHA needs to be signed by everybody. And getting 60 people, 80 people to sign, does become a bit of a challenge. And then assuming you can't get it signed by somebody, then there's a whole question on, can we deal with this? Can we live with it? Can we not live with it? I think that is one. I think two is, as you get a little older, when secondaries become viable outcomes, right? Then it again comes down to a question of who can sell how much, how many people can we sort of get to exit in one go, right? Because often what will happen is that a lot of people may initially have invested and hold only shares or 6 shares or something like that, right? By the time you get to Series A or Series B. And then you have to figure out what to do with it, how to sell it, how not to sell it, right? And there are tax complications because how equity shares get taxed will be different from how preference shares get dealt with. So, long story short, best not to have to, right? I think is the answer.
And, in fact, as you know, you had suggested some companies to us to lead engine because we manage their cap table also as a service. And we are actually seeing a lot of companies approach us today, just on the point that you was talking about, not to have a very complex tax structure, have a single share entity which owns all the shares, and the entity in turn gives out units to the various investors. So it's like, in a way, fractional ownership, whether it is in real estate and whether it is in shares or mutual funds, increasingly happening in startups. One thing which we investors worry about is, once we have decided to invest in a company, we look at, give them the term sheet, and the entrepreneur is running after us, give us the money, give us the money. And we have to do legal and financial due diligence, right? Before we can cast the shareholder agreement. So a lot of investors, even to this day, don't do a financial and legal due diligence. Or it's a very perfunctory sort of diligence that they do. Some of the well-known angel platforms also don't do any due diligence because they are not really investing in the company. They don't bother. So what's your view on due diligence? I know it's not an easy question to answer because you love doing legal due diligence, but nevertheless.
Yeah, no, I mean, obviously, right? Like, I mean, I think
You're an
our
interested party.
yes, I'm an interested party, right? But look, I think there needs to be calibration in how we look at diligence, right? I don't think there is a one size fits all sort of an outlook. Yes, you are correct that we should certainly be aware and cognizant that there are smaller companies may have just started, companies that maybe 6 months, 1 year along, maybe 5 employees, 10 employees, whose level of compliance is certainly not going to be what we'd expect from a Series B or a Series C company. I think that is something we all need to be cognizant of. There are, however, certain things that we need to be mindful of nonetheless, right? Like I began by speaking about regulatory challenges and how we need to be aware that is this even something that is so regulatorily barred that is this even going to be scalable, right?
Mm.
That is something that is important to consider.
It is very important. Where there are a bunch of companies which were in, PNPL loans, they had to close down because of RBI regulations. The companies which were selling loans for other people, they had to close down. Some gaming companies had to close down. Bunch of folks had to close down. Some of the SEBI came down on these companies which were making stock market games. Right? Recently, has come down on those. We had met recently some algo trading companies. They have a bunch of regulations affecting them. Crypto, of course, is the big one where more and more regulations every day. So yeah, I think what is important, if I had to summarize what you're saying is, A, are they kosher to invest itself? Whether that, forget about everything else. And then, depending on the age of the company and at, how many years, months or years I'm trying to put a general rule. How many months and years it is, been on the road? That is the level of diligence that needs to be. That be
No, absolutely, absolutely, right. Like, for example, that if you're investing in a company where you're coming in as an angel investor, like a food for thought, right? And say you have a situation where the founder has already diluted a fair bit, right? Say you may have a founder who's at 70%, maybe even 60% holding at that point in time. Now you know when a Series A or a Series B happens, they're going to dilute more. And you know what's happening in a deal of mine is the investor has now turned around and said, hey, you know what? Actually, I want to do a secondary, right, to make up some amount of the shareholding that I'm not going to get in a Series A. Now the problem is that if the initial shares that are being offered to the investor are not kosher, right, where legal compliances were not followed in their issuance, now you have a scenario where the new investor is turning around and saying, listen, I don't want to invest so much money because the company, the founder is too diluted. I'm happy to do a secondary to do that adjustment. But I can't do a secondary because there are so many issues with the initial shares issued, right? So maybe that's something to be mindful of, right? You may say that fine, you've not maintained a register of members, and that's fine, right? You can fix it like 6 months later, and that's okay. But suppose you've given out shares without doing any legal compliance, it could potentially end up in a complication like this in the long run, right? And I think that's the calibrated approach that what I sort of meant to say.
Got it. So let me put it the other way around, the other side of the story, that when we angel investors invest in companies, and we're very happy when a Series A investor comes along and wants to invest in, and you've been on both sides of the table, even when negotiations are going on. How important is, valuation vis-a-vis compliance and other issues, and how do people discount for non-compliance? We put it together. If there is
I
a
mean,
mathematical formula.
no, I don't think there is any math to that, right? But I do think that, I've seen more often than not, what happens is the money comes in with too many conditionalities, right? As opposed to anything else, right? I've
And
seen
much
other,
later.
and it can have truly complicated outcomes. So, there was this deal I was doing a few years back where what had happened is that the company had a bunch of non-compliances from the past. So the investor said, I'm going to do a two-tranche investment, right? So they agree to split this about $1 million, then like 7 crores, right, into two tranches. What happens is the company gets the first tranche. They're told you fix these non-compliances, we'll invest the second tranche. Company fixes non-compliances, by which time investor is like, this is not a great business anymore, right? So investor is now like, I don't want to invest this balance 3.5 crores. Companies like, but that's not really what was promised to me, right? So, it can have complications in a way you didn't really think that it can have complications in, right? And that's really, I think, the point, right? I think, obviously it is important to have a system of compliance. It is important to have things in place where you are not, it's just that it's like a butterfly effect, right? You really think that this is going to result in that, right? So, I mean, why leave that chance?
Fair enough. So one is, of course, there are delays too, that, people put conditionalities. And of course, if it is very severe, then people walk away. People walk away from a deal if there is something non-compliant. I can give you an example. This is now a pre-IPO company, but once again from IIT Bombay, this company had taken foreign investment, but they forgot to take FIPB permission. This is not a direct route by a VC. It had to come through FIPB. It was in a particular area. And the other investors just walked away. And of course, the company complied later on, and now the company has done extremely well. And the investor maybe, is thinking in hindsight, why didn't it invest despite that? But they said, look, we have a mandate. We cannot invest in an organization which is not fully compliant with the law. So those are the challenges that investors face. But do you see that over a period of time, investors are getting more and more particular about these things? I mean, you've now been you know, 5 years down the road? What changes do you see 5 years ago?
I think there are certainly investors are, like I said, I think regulatory issues, right? I think, sort of the fact that founder shares are, don't have issues. And in fact, I think it's a question that somebody just asked, right? Like, vesting and all of that, right? Like, I think founder shares don't have issues. The fact that there are no regulatory issues with the business, right? The fact that the business is not stuck in some complicated dispute with an ex-founder who's left, or, there is something like that going on, right? I think investors are certainly picky about some of those things, right? I would say that people do take a pragmatic approach where, there are things that they will say that, okay, fine, you fix it, you move on in life. And, that's something we all accept, right? But I think, like, for example, if there are fundamental issues with how the company has dealt with its share capital, right? If there are fundamental issues with, the base or the validity of the shares, right? Or if there are regulatory issues, I think their investors definitely are not so thrilled about.
Right. I think broadly, I think we've covered. If maybe if we can, I know there's a cricket match going on today, and don't want to take too much time for everybody. Can we open the, for questions? Is that okay with you, Swagata?
Should we just pick up the questions we've already received?
Yes, please. You want Priyanka will read them out?
No, I have them. So I think Priya first asked, does dematerialization solve having many shareholders on the cap table? No, so dematerialization is actually just another way to hold your shares, right? So instead of me having a good old certificate, I have it simply in my demat account. Advantages, of course, in the future, if I'm transferring, it's easier. Half the time there are problems with shares, stamp duty has not been paid, share transfer time, stamp duty has not been paid, which often become just very painful processes when you're doing secondaries. Dematerialization does make secondaries easier. Companies are usually, young companies are not very thrilled to do it because, it entails a cost, it entails increased compliances, not so much, but certainly does. But it doesn't solve the problem of you having to track a missing person down if they're not signing the SHA, right? So even if you have 80 shareholders and 80 of them are in demat, at the end of the day, you still have to kind of track them down and find them, right? So Priya, that's really the problem.
Right, Priya. Does that answer your question?
Yeah, Sushanto. Yeah, thank you.
Then, okay, so Anirban was asking how important is it to have vesting for shareholders? I've seen startup with shareholders agreement. Original founder doing great, and in the future the reverse too as well. Well, I think a business doing great is a business doing great, right? I don't think vesting is really connected to that. But why is vesting important, and why do we all sort of end up, at least I think, talk about it so much? I think the idea is that I think the idea behind vesting has always been that, look, if capital is being put up today by a fund or by an investor, then there is an expectation of that person's continuity with that, right? I mean, essentially, somebody sort of summarized it to me a few years back saying that if there is no vesting, how do I as an investor know that you're not going to take the money and leave me holding the bag 6 months from now saying, hey, you know what, actually, I don't like this business, right? Or I'm not into this business anymore. Now, vesting, of course, works in two ways, right? One is that it is meant to incentivize or say retain the founder in the company. And of course, you have to have done your own founder diligence before that to be confident that the founder is in it. The second thing is, in multiple founder companies especially, you have scenarios where one founder is leaving, two founders are continuing. And suddenly there's this whole conversation going on between the founders saying, but this third guy is leaving, he's leaving with all the value. Two of us are still there. We're trying to get this company to an IPO. We're working hard to get this company to an IPO. We have accountability to investors. And suddenly you have this whole exit panning out, which is very, very messy, right? Because suddenly these two guys are telling the third guy that, sure, you've been with us for 2 years, but the thing is, we have to do this for 3 more years. We have to get an exit in 6. Otherwise, these people will keep troubling me and you're just gone. And tomorrow, if you do end up making it big, we'll end up sort of going out of our pocket, and we will end up, effectively giving you economic value for the whole value, even though you've only been there for 2 years, right? So vesting, I think, does have incentives between the founders inter se, does of course have a value for the investor. But look, again, practically speaking, and I've heard a lot of VCs also say this, so sir, if there is a founder event, if there is a cause event, if I have to do a clawback, and if I have to sort of enforce this, to be honest, everybody's told me, frankly, you can only do it in like a Zilling or a BharatPe, where you have Series D, Series E, P investors, enough money to be able to do it. Frankly, most venture investors have told me that it's very, it's a very cost versus effort kind of a outcome on that, right? So it's one of those things.
Right, and I think we as lead angels and at Sign as well, a lot of problems with, there are young founders, they have change of minds. Companies go through, sort of roller coaster ride in its early days. A lot of founders give up, and it becomes a problem thereafter for the remaining founders and the investors, and don't know what to do. I'm just opening the house for, unmute yourself and ask a question. But there is one question here which Swaminathan has asked. What is the accountability of the person? This is the question at you.
So, I mean, I can answer it to you, and honestly, I can answer it basis something that the Supreme Court has recently held, right? So it has in fact held lawyers cannot be sued under the Consumer Protection Act, right? Unlike doctors, lawyers cannot be sued. They've said, it's professional standard, so the best thing you can do is probably file a complaint with the Bar Council. Will the Bar Council act on that complaint? How much will they act on it? I am no one to comment. You can potentially sue the lawyer if substantial lapses are found, even for damages, if you suffer damages as a function of that action. But I will also tell you, professional negligence is a very high standard to prove, right? I mean, very rarely. And in fact, I know lawyers who refuse to sue other lawyers, right? So, that's also there.
But just here, there was a recent case where chartered accountants have had not only their licenses revoked, but also, prosecuted for some of their quote unquote serious lapses.
So that's actually right. The SFIO has done a lot of that recently, with especially all the accounting frauds that happened with a bunch of these companies, right? So in fact, we were actually doing a matter, right, where it was one of these, the One Housing, right? So one of their internal auditors got embroiled in one of this, right? The SFIO came out, said it. But again, the thing is, that's different because those guys are usually auditors. They're usually sort of internal auditors or statutory auditors. So therefore, the SFIO has jurisdiction on those persons, typically by virtue of its powers under the Companies Act. Unfortunately, on lawyers, that jurisdiction doesn't exist, right? So you're
or fortunately,
or fortunately, whatever way you look at it.
Right. So Navina is asking about, in the past, the LLP was used as a pass-through vehicle, right? As an investment pooling vehicle. Like you said, that you shouldn't have too many shareholders. In the past, people used to form LLPs and invest in companies. Does that work, and is it still working, and what are the challenges there?
So complicated question, right? And it's complicated for several reasons. What the RBI says is a non-banking financial company is a company whose substantial assets are financial assets, so shares, and substantial income is income which arises from those financial assets, so sale of those shares. Now, if you meet the income and asset test, which is you become an NBFC and therefore are subject to RBI regulation. Now, the problem with the RBI Act, Section 45IA, is that it uses the expression company, which means that if you have an entity which is not a company, which only holds shares and which only deals in those shares, the RBI has no power to regulate. That is an NBFC. You can, of course, be regulated. The SEBI has powers to regulate brokers, the SEBI has power to regulate underwriters, merchant bankers who otherwise deal in securities. But the problem is, you stay out of an NBFC, but you're not really dealing in securities like the way that the broker is either, right? So you're not subject to SEBI regulation either. Therefore, when the LLP exists, is in that gap. It exists because the RBI Act falls slightly short of regulating it. And it's not really falling into SEBI's jurisdiction or domain of things. Which is why, in fact, the MCA had come out and said, if you set up an LLP with its objective as investment, it will not give you permission. So which is why all these LLPs, which in fact double up as holding companies, have all their objects as like, consultancy, support, assistance with like, services, things like that, right? Because you can't actually register it. Now, you have an entity which is registered because there's a legal gap with an object which is wholly inconsistent with actually what it's doing, which is then being used as an investment entity to invest in another entity. Now, the other thing is also, how does SEBI define a fund? SEBI defines a fund as a privately pooled vehicle for a specified or defined investment objective. Can you say that the LLP meets that test? The answer is you could probably say that the LLP meets that test because it is privately pooled, raising money from specific persons for a defined investment or objective. So you could probably say that the LLP meets that and therefore should register as an AIF. The problem is that it's not really legally very clean. Yes, people use it, and in fact, one of the most common users today have become if you want to set up an American holdco, because the Indian sort of foreign exchange regulation doesn't permit an individual to own a company outside India, which is a subsidiary back in India. So I know a lot of people who set up LLPs, which then invest in this company outside India, which then have a subsidiary back in India. Now, I know a lot of people have turned around and said, oh, but you know what? The RBI has never really required people to unwind. They just only instruct and they may impose penalty. They may say that don't do this going forward. So I think we're all really living under that cover expectation. But will you say it's legally perfect? I would never say it's hazard to say it's legally perfect, right?
Got it. Yeah. Priya has a question.
Yeah, so we have a question in the chat box by Mr. Loknath Akula. So he has two questions. First one is there any limitation for shareholders count to kick off an investment or a startup?
You mean in the sense of even if can one investor be enough? The answer is yes, right? And one investor can be
Okay.
there.
And is there any percentage for a minimum and maximum levels to be defined with regards to funds raised change?
No, again, there isn't, right? I mean, the law so earlier the Companies Act, in fact, if you were doing a private placement of securities, did have a sort of rule which said that minimum investment must be 50,000 rupees. That rule's not been around for some time now. So effectively, you can raise as little money as you want, as long as, of course, right, the sort of lowest common denominator of that process is the number of shares, right? You can't go below one share or you can't go below one CCD, right? Or whatever the instrument that you're doing, you can't invest in fractions. So the Companies Act basically says as long as you're doing something fractional, it's fine.
Great. Thank you. Thank you. I hope that answers your question.
Yeah.
We have a next question from Priya Parthasarathy. She says, in a seed round, what are the parameters would you look for when there is a limited data? How much of a risk does a TDR at that stage would get covered approx?
See, I think the approach depends, like Sushanta mentioned a while back, on the age of the company, right? Like I'm just doing an investment where the company got incorporated, received money in like some 2 months, right? So what are you going to diligence then? Because the company's literally just been incorporated. Sure, you can at most check the founders don't have criminal cases. You can at most check that the company is actually really incorporated. So the intention is that obviously you can't do much diligence at all. And you, like I said, you will check if the business is regulated, not regulated. What is the business, right? You can't. But if suppose the company is ending up doing a seed round, say a year later, 2 years later, something like that, then there are potentially things you can check, right? And ultimately, I think what we call seed, what we call pre-seed, what we call pre-seed, angel round is really just all our nomenclature, right? I don't think it really depends on history, is what I would say.
Correct. Correct. Great.
Anybody would like to ask a question? Is there any more questions?
Yes. So we have a question from Anirban. He says, since he is working on a liquor delivery application called Pegman, compliances are critical, but I'm aware of that and did my due diligence. Still, do you recommend hiring a third-party specialist firm for startup? What would you do? Like, as a if you're in
See,
his shoes.
See,
Yeah.
like again, I think for example, it's worked out differently for different people, right? Like I have a client who's in sort of the payout business, right? RBI has recently sort of moved around a lot in that, and so one of the things that was asked for them is that give me a legal opinion from a firm by an investor, right? And this is, I'm not even talking about a term sheets. I'm talking about pre-term sheet stage, right? When these conversations are just going on. They're like, show me a legal opinion which says that this business works in India, because we know the RBI is very active in this way. And 3 years back, somebody in gaming I used to work with was asked the same question, right? Like, tell me that this is legal. Tell me where are you offering this? Tell me what are you doing, right? So I think it's a bit of a question in terms of if you feel you're in a space where it's a little gray, if you feel like you're in a space where questions could get asked like this, it's maybe worthwhile just to do it. Just so if somebody comes and asks a question, you can always be like, listen, I have something which says this is fine.
I would second that. I think especially the liquor business is, of course, lots of regulations, and B, there is a general sense of righteousness that people want to apply these rules to you. There's a company called Dulali, which makes draft beer. It took 16 years or 7 years, 7 years to get their excise license, because the excise laws say that the excise is administered when you take the goods out of the brewery. But if it was a sort of microbrewery, the people consume the beer inside the brewery, right? So how and where can you tax it? And it took them a long time to get that thing. Also, it's a state subject, so different states' regulations are different. And anybody who wants to have a rule around alcohol will have one. So I would say get a second and a third opinion about it.
No, exactly, right. I mean, I think some of these businesses, like you said, like maybe liquor, maybe
Gaming,
payments,
gambling, all these things.
I think the next set of questions are really, Sushanta, you're better at answering than
Yeah.
me.
So what factors of course, Priyanka, if you can read it out to me, please.
Yeah, just a second.
Yeah, because there's bunch of questions after that. So
Yeah. So Kanika has asked, what are the factors that really influence you to invest into a startup, and what stage do you generally prefer? So Kanika, I'm guessing you run a startup, or you're an entrepreneur, or you're in line of raising funds. Okay, I
maybe I'll try to answer
yeah,
the question. We can ask her the question.
sure.
Say, as far as Lead Angel is concerned, we don't invest in pre-revenue companies as a general rule. With the because market validation is very critical for us, given the risk profile of what our investors would like to go in. We obviously can't go and get in till when it's very late, because then the valuation of the company is very high. The stage that we like to get in is the company has raised is post revenues, friends and family round is over, and we are the first institutional check which is going to the company. Increasingly, we invest alongside other investors so that there is, a strength in numbers. Um,
Okay.
Mukta
I hope,
question, which
yeah.
sectors? Yeah. So, this is like the stock markets, before uh, when the exit polls were announced, everybody was investing in PSU stocks and PSU banks and railway and everything. And the moment the results started coming in, everybody started dumping those shares and buying uh, Unilever and Procter and Gamble. So investors also, VC investors also behave somewhat like that. Having said that, in India, there are one is of course tech. In all startup businesses which have done well, tech is a very critical part. So, and the other is the areas where there is a gap. So, fintech is one. Fintech has been the largest sector that VCs have been investing in the last 2-3 years. Uh, Sectors like clean tech, that's another sector where a lot of investment is going in. AI and AI applications look interesting from that point. And I think if you believe in the general Indian consumers consumption story, then B2C brands which are operating in areas which are still small in India. I was just surprised to find a company which primarily makes a product for potty training of pets, doing 50 lakhs a month. So, that is the sort of, and of course, there are no big players in that space. Even niche areas in consumer businesses could be very interesting in the years to come.
I think somebody had a question on advisor equity, right? And how does that work?
Correct. Yeah, Weber has a question. So, if two people have formed a private limited company to invest in startups and advising a startup, the startup wants to extend advisory equity to you. What is the best way to take it without any tax implication on the advisor? In cases where the startup has already done a priced round as well, as if they have just done a convertible round and no equity has been converted yet.
So I think that's a very specific question, and I think,
Yeah.
and I think the point is obviously, ordinarily I would have sent a fee code, but but jokes aside, look, I think advisor equity is one of those really complicated issues, right? The problem is that in India, you don't really have an option of sort of doing stock options to non-employees, unlike how you can do it in America. The solution to what is the best way for you to receive advisor equity or economic value of that advisor equity, right? I think will require you to look at tax considerations and certain Companies Act considerations, right? I think there are questions where you can look at it and say that, okay, it may be better to maybe do a share transfer and you can work it out, right? Because if you say that, okay, this is how much the tax is working out, I can work that out. Sometimes it may be better for you to say, it's okay. The tax may not be a very favorable outcome, so I'd rather do a phantom stock, right, where I get paid the delta of what the company promises value today versus where it turns out in a liquidation event, right? So I think how to do it will depend a little bit on where the company is at, how much is the investor sort of wherewithal maybe to bear some tax, how much is the upside you're looking at. I think you need to take some of these issues into consideration.
But just to add here, Swagata, so when you're saying phantom shares, you essentially mean share appreciation rights, right?
Yes, that's right.
And in a broad way, I mean, if I were to answer, that is at least while they may be complex to issue them, that's the most tax friendly one because there is no incidence of tax when you issue these shares to either party.
Well, yes and no, right? Because the thing is, in a phantom stock, you would be essentially paid the cash as the difference, right? And the point is, you
That
will
will get
always,
taxed.
It'll always be taxed
That
at
will get
marginal
taxed
rate.
at their marginal rates.
But with a share, assuming you're managing an actual equity, and then Sarad, you may be able to take advantage of capital gain taxes. You may be able to sort of take advantage of
Initially,
non-resident.
it is less tax, it's tax friendly in the beginning, but may not be tax friendly at the end.
In the long run, yes, yeah.
May or may not. Any more questions?
So Vaibhav didn't get an answer, but got an answer.
So we have a question from Priya. How significant is profitability as a parameter to decide to invest? Sushanta, maybe you want to
Yeah.
take it up.
Yeah. So I think, again, this is all businesses and in the end must make money, right? And the question is that how long should investors wait before a company start making money? Case of Facebook took 7 years to start making profitable. We recently know about what happened to WeWork going bankrupt, and Uber still having a lot of problems in many other countries apart from India. So profitability is important, but investors are sometimes willing to wait for a company to take a huge share of the market before it becomes profitable. So they're saying they're actually investing in building a monopolistic sort of business like Amazon or Facebook. But if I'm selling potato wafers and I keep on making losses year after year, that is not something an investor is going to appreciate, because there are 20 other brands of potato wafer. If I'm in a monopolistic situation or there are very few players in my sector, and I'm willing to, and I'm doing this primarily to garner market share, then investors are willing to wait for you to become profitable. But otherwise, increasingly, and with every crisis in the investment world, profitability is becoming something which investors look at in majority of investment. So if you're not profitable today, at best they'll say, okay, will you be profitable in 2 years' time? Will you be profitable in 3 years' time? But not many investors are willing to wait longer than that for most businesses.
And sorry, to answer two of Weber's follow-up questions on, can warrants be used to get around advisory limitation? Yes, warrants are a good way to lock pricing, right? Compliance is high though, so sometimes people are not very thrilled to do it because you have to follow the whole private placement process. As to Meesho having issued ESOPs to their merchants, so again, how option trust works is different from how an option plan works. Yes, if you have a trust, you can do a lot of these things. If you have an ESOP trust in place, most companies at a seed stage, pre-series A, don't really have a trust, and it's a cumbersome process to set up a trust. But yes, to answer your question, you could do a trust and do it.
So I think I know the match has already started in between India and US. So it's also 9 o'clock, almost 9 o'clock. So if there are any more questions, please feel free to email them to us. And even for those questions, so Swagata has promised that he won't send an invoice for them. And we'll, of course, be happy to answer those questions. Thank you so much, Swagata, for being here. And I know some of them. So Vaibhav has also given us the score. Thanks, Vaibhav.
So Vaibhav, I guess, is watching the match and
Yeah.
great.
Great. Yeah.
Great.
So that, and I think the Mukta says EdTech is kind of fading out. So Mukta, I think today, EdTech for the last 4 years has been especially the last 2 has been in a bad space. But I don't think that it can be written off. The sectors will revive. Who had thought that defense stocks would become interesting? But health and agri these are areas which are, evergreen sectors. So those will remain. I
Great.
hope that answers your question. Great. So we are 1 minute to go. Thank you everyone for attending, taking time out, especially for the match. We're some of you must be waiting to, spend more attention on the match. Thanks to Swagata once again.